When someone says they're moving to Florida, the question nobody asks is, which Florida? Not which neighborhood, not which county, which market, which version of the bet. Because Tampa and Orlando and Jacksonville are not variations of the same city. They are three completely different financial propositions sitting inside the same state, wearing the same sunshine, and they will do three completely different things to your balance sheet over the next 10 years. Most people never figure that out until they've already signed the lease or closed on the house. By then, the decision is made. Here's what the relocation conversation in 2026 actually looks like. Someone in Los Angeles, paying $4,400 a month for a 3-bedroom rental in Culver City, watching their savings account do nothing, doing the math on what a down payment in California actually requires. It starts Googling. They find the same 15 articles, the same 5 cities, a few real estate agent videos that are barely disguised, listing pitches, and somewhere in all of that noise, Florida comes up. Florida always comes up. No state income tax, relatively affordable compared to California or New York, jobs growing, population growing, weather that doesn't require a winter coat. The pitch is solid. The problem is that Florida is doing a lot of heavy lifting in that sentence, and nobody stops to pull it apart. Miami is not the answer. Let's get that out of the way right now. Miami had its moment, and it was a real moment. It made real people real money. But that moment was 2013 through 2021. The median home price in Miami today reflects all of that appreciation, all of that demand, all of that international capital that poured in during the pandemic relocation wave. If you're buying in Miami in 2026, you are paying for someone else's return. The upside was priced in years ago. The people who are going to make generational money in Florida real estate over the next decade are not buying in Miami. They're buying somewhere else. The question is where? That's the conversation this analysis is built around. 3 cities examined honestly, with the numbers that the blogs don't run and the comparisons that the relocation content on almost never makes. Tampa, the market that already matured, that already had its run, that already became the thing everyone said it was going to become. And that still, despite all of that, offers something the other 2 cities don't. Orlando, the tourism engine with a second story developing underneath it, riskier than it looks in some directions and more interesting than it looks in others. And Jacksonville, the city that keeps showing up in the data and keeps not showing up in the conversation, which is exactly the kind of asymmetry that serious people pay attention to. The numbers that frame everything here are simple. Tampa's median home price is $395,000. Orlando sits at $370,000. Jacksonville is at $295,000. Those 3 numbers alone tell a story, but they only tell the beginning of it. Because the price of the house is not the cost of owning the house in Florida. In Florida, insurance is not a footnote. Insurance is a core variable in the financial model, and the difference between these 3 cities on that single line item is significant enough to change which city makes sense for your specific profile. We'll go deep on that, but first, understand the frame. These are 3 different markets, 3 different risk profiles, and 3 different answers depending on what you're actually trying to accomplish. There's a version of this story that becomes obvious in hindsight. Tampa in 2015 was a market most national investors were not paying attention to. The median home was under $200,000. The job market was diversifying out of its post-recession fragility. Net migration was accelerating. The infrastructure investment was underway. The people who looked at those fundamentals in 2015 and made a decision, they didn't need to be geniuses. They needed to be paying attention. Jacksonville in 2026 has a job growth rate of plus 3.1%, the highest of the 3 cities we're analyzing. It absorbed 28,000 net new residents in 2024. That number gets almost no press. The median home is $295,000 in a state where the conversation is dominated by markets that are $50,000 to $100,000 more expensive. The pattern is not identical to Tampa in 2015, but the shape of it is familiar enough that ignoring it requires a deliberate choice. By the time this analysis is done, you'll have a complete financial picture of all 3 markets, not the promotional version, not the real estate agent version, but the version built from insurance costs, price-to-income ratios, job market data, and what each city actually does to a household budget over 5 and 10 years. One of these cities is the right answer for someone who wants quality of life with manageable risk. One of them is the right answer for someone with higher risk tolerance who wants asymmetric upside in specific corridors. And one of them, the one with the quietest press and the strongest fundamentals, is the answer for someone who wants to look back in 10 years and say they were paying attention when it mattered. Keep that in mind as we go through each market. One city in this analysis has a window that is still open. It will not stay open indefinitely. Think about Stephanie for a moment. 41 years old, 2 kids, paying $4,400 a month to rent a 3-bedroom in Culver City. She's not looking for the next big speculation play. She's looking for a place where the schools are decent, the neighborhood feels stable, the commute doesn't destroy her, and where $395,000 actually buys her something real. A house, a yard, a future that doesn't depend on her landlord deciding not to sell. Tampa is the city that shows up on her short list first, and for good reason. But the story of Tampa in 2026 is more complicated than the version that shows up in the relocation content. And understanding that complexity is what separates a good decision from a great one. Tampa's median home price is $395,000. That number needs context before it means anything. 4 years ago, that same median was closer to $260,000. The appreciation curve in Tampa was steep, fast, and real, driven by net migration, remote worker relocation, and the kind of lifestyle quality narrative that spreads through word of mouth and eventually ends up on every best cities list in the country. Tampa already had that moment. The city was discovered, priced, and repriced in the span of about 36 months. And what you're looking at now is a market that reflects its own reputation. That's not a reason to avoid it. It is, however, a reason to be precise about what you're actually buying. What Tampa offers in 2026 that most people don't fully quantify is economic diversification. This is not a one-sector city. Tampa's economy runs on financial services, healthcare, defense contracting, and a growing professional services corridor that has been pulling companies out of more expensive metros for the better part of a decade. MacDill Air Force Base alone represents a permanent, recession-resistant employment anchor that most Sunbelt cities don't have. The University of South Florida feeds a consistent pipeline of talent that keeps younger demographics in the market. Busch Gardens and the tourism layer exist, but they're not the load-bearing wall of the economy the way they are in Orlando. When you stress test Tampa against a recession scenario, the diversification holds up better than most comparable Florida markets. The flood risk conversation about Tampa is one that deserves honest treatment rather than the dismissal it sometimes gets from people who want to sell you something. Tampa Bay is a real geographic vulnerability. The region has a well-documented hurricane exposure profile, and anyone telling you otherwise is either uninformed or has a listing to close. What the data actually shows, though, is that the flood risk in the Tampa Bay metro, when mapped at the zip code and neighborhood level, varies enormously. St. Petersburg's inland neighborhoods, parts of New Tampa, Wesley Chapel, and several corridors in Hillsborough County carry flood zone designations that are meaningfully lower than what you'd face on Miami Beach or in many parts of Broward County. The insurance cost reflects this. In Tampa's median annual insurance bill is $5,100, the highest of the 3 cities in this analysis. But compare that to coastal Miami, where policies in high-risk flood zones routinely run $8,000 to $12,000 annually, and the picture shifts. Tampa's insurance number is the worst among our 3 cities, but it is not the worst version of Florida. The job growth figure for Tampa in 2025 was plus 2.6%. That's a healthy number, above the national average, above what you'd see in most Midwestern markets, and indicative of an economy that is still expanding rather than consolidating. The important nuance is that Tampa's growth rate has moderated from the peak years of 2021 and 2022, when the relocation wave was driving both population and economic activity at an unusual pace. What you're seeing now is a market settling into sustainable growth, rather than speculative acceleration. For a buyer like Stephanie, someone who wants stability, school quality, and a 10-year time horizon, that moderation is actually a feature. Volatile markets with high ceilings also have lower floors. Tampa's floor is well established. The quality-to-cost ratio in Tampa and St. Pete is the strongest argument for this market, and it's the metric that most relocation content underweights. For $395,000 in the Tampa Bay Metro, you are buying into a genuinely functional city. An international airport with direct routes to most major hubs, a downtown waterfront that has undergone a legitimate revitalization over the past decade, a restaurant and culture scene that punches above its population weight, and neighborhoods like South Tampa, St. Pete's Old Northeast, and Seminole Heights that offer the kind of walkable urban fabric that Stephanie's profile gravitates toward. You are not making a sacrifice play. You are buying a real city at a price that would get you a 2-bedroom condo with a parking space in Culver City. That comparison is not rhetorical. It is the financial reality that makes Tampa the best quality-to-cost ratio in this analysis. Here's where to be clear-eyed about Tampa's limitations going forward. The easy money in this market has already been made. If your investment thesis depends on another 30 to 50% appreciation run in the next 5 years, the data does not support that bet. Inventory has increased, days on market have stretched, and the price-to-income ratio for local earners is already stretched past the point of organic demand, driving another major leg up. Tampa is the right answer for someone who wants to live well, build equity at a reasonable pace, and operate from a stable, diversified metro. It is not the right answer for someone chasing the maximum return on a buy-and-hold residential investment. For that profile, the analysis points somewhere else, and we'll get there. Kevin is 29, earns $92,000 a year, and has been reading about real estate investing for 18 months without pulling the trigger. He's not afraid of risk. He's afraid of the wrong risk. He wants upside, but he wants upside that's backed by something structural, something that doesn't evaporate the moment a recession hits or a major employer decides to relocate. When Kevin looks at Orlando, his first instinct is skepticism. A city whose economy runs on theme parks and convention centers feels fragile by definition, and he's not wrong to feel that way. But the Orlando of 2026 is not a single-layer economy anymore, and the people who are still analyzing it as if it is are working with an outdated map. Orlando's median home price is $370,000. That number sits between Tampa and Jacksonville, lower than the market that already matured, higher than the market that hasn't been discovered yet. The insurance median is $3,900 annually, which reflects Orlando's inland geography and its relative distance from the direct hurricane strike zones that punish coastal markets. Job growth in 2025 came in at plus 2.1%, the lowest of the 3 cities in this analysis, a number that deserves both honest acknowledgement and honest context. 2.1% growth in a metro of roughly 3 million people still represents tens of thousands of new jobs. The question is what kind of jobs, in what sectors, and whether the foundation they're built on is durable enough to support a 10-year financial bet. The tourism dependency is real, and it carries real risk. Walt Disney World, Universal Studios, SeaWorld, and the convention economy around the Orange County Convention Center collectively represent a disproportionate share of Orlando's employment base. In a normal economic environment, that's a stable if unspectacular foundation. Tourism is largely recession-resistant at the premium end, and Orlando's theme park product is premium. In an abnormal environment, a pandemic, a major hurricane, a sustained consumer spending contraction, that foundation shows its vulnerability fast. In 2020 was a live demonstration. Orlando's unemployment rate spiked sharply, the hospitality sector collapsed, and the market absorbed a shock that a more diversified economy would have handled more smoothly. Anyone building a long-term financial model on Orlando without stress testing it against that scenario is being optimistic in a way the data doesn't support. Here's what changes the Orlando calculus, and it's the part that most relocation content misses entirely. Over the past several years, a quiet but accelerating technology and life sciences corridor has been developing along the Interstate 436 corridor and around the Lake Nona Medical City development on the city's southeast side. Lake Nona is not a strip mall with a hospital attached. It is a purpose-built medical and research campus that has attracted the United States Tennis Association, a VA medical center, a cluster of biotech and health tech companies, and a residential development ecosystem that has grown faster than almost any master-planned community in the country. The employers anchoring that corridor are not tourism-dependent. They are research institutions, healthcare systems, and technology companies that exist independently of how many people visit the Magic Kingdom in a given quarter. The Lake Nona zip codes, Mainshi, along with parts of the East Orlando corridor around the University of Central Florida Research Park, represent the version of Orlando that Kevin's profile should be paying attention to. In those specific markets, the tenant base is different, the income demographics are different, the demand drivers are different, and the long-term appreciation trajectory is being powered by institutional investment and infrastructure rather than by vacation rental demand or seasonal population fluctuation. The cap rates in these corridors in 2026 are not as attractive as they were 3 years ago, but they are still meaningfully better than what comparable properties produce in Tampa's most desirable neighborhoods. For an investor willing to do the zip code level analysis rather than the city level analysis, Orlando rewards the precision. The honest version of Orlando's risk profile for a buyer or investor in 2026 looks like this. The macroeconomy of the city carries more volatility risk than Tampa's diversified base. A major tourism disruption would hurt Orlando faster and deeper than it would hurt a city with stronger institutional employment anchors. The insurance cost, while lower than Tampa's, has been trending upward as carriers continue to reprice Florida risk across the board, and there is no guarantee that the $3,900 median figure holds over a 5-year horizon. The price-to-local income ratio is stretched in the same way it is in most Sun Belt markets that absorb significant remote worker migration between 2020 and 2023. These are real risks, and they belong in the model. What Orlando offers in exchange for accepting that risk profile is a specific kind of upside that neither Tampa nor Jacksonville currently provides in the same form. The tech and life sciences layer is still early enough that it hasn't been fully priced into the corridors where it's growing. The University of Central Florida is the largest university in the United States by enrollment, and the research commercialization pipeline it generates is a long-term demand driver that compounds quietly over time. The city's infrastructure investment, particularly around transportation and the medical city development, signals institutional confidence in a growth trajectory that extends well past the current cycle. Orlando is not the right answer for someone who needs stability above all else. It is the right answer for someone who has done the zip code work, understands what they're buying, and is positioned to hold through the volatility that comes with a market that is still in the middle of its transformation. Keep that distinction in mind as we look at what the third city in this analysis is doing, because Jacksonville offers something that neither Tampa nor Orlando can match right now, and almost nobody is talking about it. There is a particular kind of market that serious investors learn to recognize over time. It doesn't show up on the magazine covers. It doesn't generate the think pieces or the Twitter threads or the relocation influencer content. It shows up in the data quietly, consistently, across multiple indicators simultaneously, and the people who are paying attention to the data rather than the narrative see it before the narrative catches up. Jacksonville in 2026 is that market. The median home price is $295,000 in a state where the dominant conversation happens around markets that are $50,000 to $100,000 more expensive. The job growth rate is plus 3.1%, the highest of the 3 cities in this analysis. In net migration in 2024 was 28,000 people. That number gets almost no national press. That gap between the data and the coverage is exactly the kind of asymmetry that precedes a repricing. Let's put the $295,000 median in real terms. For Kevin, a financial analyst earning $92,000 a year, currently paying $2,100 a month to rent a one-bedroom in Chicago, that median price represents a mortgage payment in the range of $1,700 to $1,900 a month at current rates with a standard down payment. He would be paying less to own a house in Jacksonville than he currently pays to rent an apartment in Chicago. That is not a marginal improvement. That is a structural change in his financial position, and it happens on day one, before any appreciation, before any equity accumulation, before any of the long-term compounding that follows. Seeing the entry price alone makes Jacksonville the most accessible ownership market of the three cities in this analysis. For a buyer at Kevin's income level, the job growth number requires explanation, because 3.1% doesn't land with the same weight as a brand name, employer announcement, or a headline about a corporate headquarters relocation. What drives Jacksonville's employment growth is a combination of factors that are individually unglamorous but collectively durable. The financial services sector, which includes major operations for companies like Fidelity Investments, Bank of America, and Citigroup, has had a significant presence in Jacksonville for decades and continues to expand. The logistics and distribution infrastructure anchored by the Jacksport container port makes Jacksonville one of the most important freight hubs on the southeast Atlantic coast. The military presence at Naval Air Station, Jacksonville, and Naval Station Mayport represents the same kind of permanent, recession-resistant employment anchor that MacDill provides to Tampa. These are not startup jobs or gig economy positions. They are institutional employment at scale, and they create the kind of demand stability that supports long-term residential real estate fundamentals. The 28,000 net migration figure from 2024 is the data point that deserves the most attention and gets the least. For context, Jacksonville is a city of roughly 1 million people in the metro area. Adding 28,000 net new residents in a single year represents a growth rate that is meaningful at that scale. People who need housing, who need services, who need the economic infrastructure of a functioning city to expand to meet their presence. The important word in that figure is net. It accounts for people leaving as well as people arriving, which means the underlying in-migration number is even higher. These are not tourists or seasonal residents. They are people who chose Jacksonville as their permanent market, signed leases, bought homes, enrolled kids in schools, and started building local economic activity. That process compounds. The people who arrive in year one create jobs and demand that attract more people in year two and year three. Here is the Tampa, the 2015 comparison stated plainly. In 2015, Tampa's median home was under $200,000. The city had a diversifying economy, accelerating net migration, job growth above the national average, and almost no national relocation coverage. The people who bought in Tampa in 2015 and held for 7 years saw their equity position transform in ways that were not available in the already discovered markets of that era. Jacksonville in 2026 does not have an identical setup. No two markets are identical, and pattern matching has limits. What Jacksonville does have is a median price that is still low enough to allow genuine upside, a job market that is outperforming its peers, an infrastructure investment cycle that is underway rather than completed, and a net migration trend that is accelerating without the price discovery that normally follows. The window that existed in Tampa in 2015 is not infinitely open. Markets get discovered, prices adjust. The question is not always whether you're in front of that adjustment or behind it. The insurance picture in Jacksonville is the final piece that completes this market's case. The median annual insurance cost is $2,800, the lowest of the three cities, and significantly lower than Tampa's $5,100 figure. The reason is geography. Jacksonville sits in northeast Florida, away from the peninsula's most vulnerable hurricane corridors, with a flood zone profile that is meaningfully better than the coastal and near coastal markets that dominate the Florida real estate conversation. That $2,300 annual difference between Jacksonville and Tampa is not a small number when you model it over 10 years. It is $23,000 in cumulative insurance costs, money that, in Jacksonville, stays in your pocket or goes toward your mortgage principal instead of disappearing into a premium. For an investor running a cash flow analysis, that difference alone can be the margin between a deal that works and a deal that doesn't. Jacksonville is the market where the numbers align from multiple directions at once. That doesn't happen often. When it does, the smart move is to notice. Most people building a relocation spreadsheet for Florida do the same thing. They pull the median home price, they estimate a mortgage payment, they look up property tax rates, and they feel like they've done the work. No, what they've actually done is build a model with a missing variable. And in Florida, that missing variable is large enough to change which city makes financial sense for their specific profile. Homeowners insurance in Florida is not a footnote. It is not a rounding error. It is a core monthly expense that in some markets rivals the cost of the mortgage itself. And the difference between the three cities in this analysis on that single line item is substantial enough to deserve its own dedicated examination. Here are the numbers stated plainly. Tampa's median annual homeowners insurance premium is $5,100. Orlando's is $3,900. Jacksonville's is $2,800. The spread between the most expensive and the least expensive market in this analysis is $2,300 per year. Over a 10-year ownership horizon, that differential compounds to $23,000 in cumulative costs, money that a Tampa homeowner pays to their insurance carrier and a Jacksonville homeowner keeps. That is not a trivial sum. For someone like Stephanie, who was trying to build real financial stability for her family after years of renting in Los Angeles, $23,000 over a decade is a car paid off, a college fund contribution, a meaningful addition to an emergency reserve. It does not disappear. It simply goes to a different place depending on which city she chooses. The reason for the spread is geography, and understanding the geography helps you understand whether the trend in each market is likely to improve or worsen over time. Tampa sits on Tampa Bay, a large, shallow water body that creates specific storm surge vulnerability during major hurricanes. The Pinellas Peninsula, which includes St. Petersburg, is almost entirely surrounded by water, and while the flood zone designations vary significantly by neighborhood, the aggregate risk profile of the metro commands a higher insurance price. Carriers have been pricing Florida risk more aggressively for several consecutive years, and Tampa's coastal and near-coastal exposure puts it in the segment of the market that has absorbed the steepest rate increases. The $5,100 median is not the ceiling. It is the current midpoint of a range that extends significantly higher for properties with unfavorable flood zone designations. Orlando's $3,900 figure reflects its inland position. The city sits roughly 60 miles from both the Atlantic and Gulf coasts, which removes it from the most direct hurricane strike zone vulnerability and from the tidal and storm surge risk that drives the highest premiums in coastal markets. Wind damage from major storms is still a real exposure. Orlando is not immune to hurricane impacts, and the 2004 and 2017 seasons demonstrated that inland markets can absorb significant property damage from major storms that make landfall on either coast. But the absence of flood zone complexity and tidal exposure means that Orlando's insurance profile is structurally lower than Tampa's. And the trajectory of rate increases in the inland market has been less severe than what coastal policyholders have experienced over the past 4 years. Jacksonville's $2,800 median is the product of both its inland-leaning geography and its position in northeast Florida, outside the zone where the peninsula's narrowing coastline creates the most concentrated storm vulnerability. The St. Johns River creates some localized flood exposure in specific neighborhoods, and properties adjacent to the river or its tributaries carry higher premiums that reflect real flood risk. But the zip code level variance in Jacksonville means that a buyer doing property-specific due diligence, rather than relying on metro-level averages, can identify assets with insurance costs well below the median. For Kevin's investor profile, that granularity matters. A property with a $2,200 annual insurance cost in a Jacksonville neighborhood with strong rental demand produces meaningfully better cash flow than a comparable property carrying a $4,500 premium in a Tampa zip code with flood zone exposure. There is a forward-looking dimension to this analysis that most people skip because it requires thinking about insurance as a dynamic variable rather than a fixed cost. Florida's insurance market has been in structural stress for several years. Multiple carriers have exited the state entirely. The state-backed Citizens Insurance Program has expanded beyond its intended scope, and reinsurance costs, the cost that insurance companies themselves pay to insure their exposure, have risen sharply in response to the increased frequency and severity of major weather events. The direction of travel in Florida insurance costs is not ambiguous. Premiums are going up across the board, and the markets with the highest current premiums are facing the steepest trajectory of future increases. Even when you model Tampa's insurance cost over a 10-year horizon, using even a conservative annual increase assumption, the cumulative difference between Tampa and Jacksonville grows beyond what any comparative home price advantage can offset. The insurance line in your Florida financial model is not static. It is a compounding cost with a direction, and that direction should inform which market you choose as much as the purchase price does. Stop thinking about these cities in the abstract and start thinking about them in terms of what they actually do to a specific financial life. The most useful thing this analysis can do at this stage is not describe neighborhoods or rank amenities. It is to run the actual math on a standardized profile and show you what each city produces. So here is the profile: a household income of $100,000 per year, relocating from a high-cost market, purchasing a home at or near the city's median price with a 20% down payment, and holding that property for 10 years. Same income, same financial starting point. 3 completely different outcomes depending on which city they choose. Let's go through each one. In Tampa, a 20% down payment on a $395,000 home is $79,000. The resulting mortgage on $316,000 at current 30-year fixed rates produces a principal and interest payment in the range of $2,050 to $2,100 per month. Add property taxes. Hillsborough County runs at roughly 1.1% of assessed value, so approximately $360 per month, and the $5,100 annual insurance premium, which is $425 per month. Total monthly housing cost before maintenance and HOA fees, approximately $2,835 on a $100,000 gross income. That represents roughly 34% of gross income allocated to housing. Tight, but within range, and meaningfully better than what the same household would pay in a high-cost origin market. The price-to-income ratio at the median in Tampa is 3.95. For a buyer at this income level, that ratio is manageable. For a local Tampa resident earning the area median household income of around $65,000, it is not. In Orlando, the same exercise produces a slightly different picture. Awesome 20% down on $370,000 is $74,000, saving $5,000 at entry compared to Tampa. The mortgage on $296,000 generates a principal and interest payment of approximately $1,920 per month. Orange County property taxes run at roughly 1% of assessed value, about $308 per month. Insurance at $3,900 annually is $325 per month. Total monthly housing cost, approximately $2,553. That is $282 per month less than Tampa, a difference of $3,384 per year. And on a 10-year horizon, that cumulative difference approaches $34,000 before accounting for any difference in appreciation between the two markets. Orlando's price-to-income ratio at the median is 3.7, slightly better than Tampa's, though the job market volatility risk means that ratio is more sensitive to an economic disruption than Tampa's diversified employment base would be. Jacksonville is where the numbers separate most clearly from the other two cities. 20% down on $295,000 is $59,000. $20,000 less in capital required at entry compared to Tampa. The mortgage on $236,000 generates a principal and interest payment of approximately $1,530 per month. Duval County property taxes run at roughly 1.1%, approximately $270 per month. Insurance at $2,800 annually is $233 per month. Total monthly housing cost, approximately $2,033. That is $800 per month, less than Tampa, $800 per month. Thane, that is $9,600 per year, staying in the household budget rather than going to housing costs. Over 10 years, that is $96,000 in cumulative cost difference. And that figure does not include the compounding effect of investing or saving that monthly difference. Jacksonville's price-to-income ratio at the median is 2.95. That is the only market in this analysis where the median income household of the city can realistically afford to buy at the median price. Now project equity at year 5 and year 10 using conservative appreciation assumptions. For Tampa, applying a 4% annual appreciation rate, modest by recent historical standards but more defensible given the market's maturity, produces a year 5 estimated value of approximately $480,000 and a year 10 value of approximately $585,000. Equity at year 10, accounting for principal paydown, roughly $310,000. For Orlando, at the same 4% annual appreciation assumption, year 10 value reaches approximately $548,000, with equity approaching $285,000. For Jacksonville, in using the same 4% assumption, which is almost certainly conservative given where the market sits in its growth cycle, year 10 value reaches approximately $436,000, with equity of approximately $230,000. But apply a 6% appreciation assumption to Jacksonville, still below what Tampa averaged during its growth phase, and the year 10 value climbs to approximately $528,000, producing equity comparable to or exceeding the Tampa and Orlando projections at a lower entry cost and with a lower insurance drag throughout the holding period. Here is what those numbers mean in plain language. Tampa gives you the best quality of life per dollar spent on housing, the most stable economic foundation, and a predictable, if unspectacular, equity trajectory. You are buying certainty and comfort at a fair price. Orlando gives you a slightly lower entry cost, a lower insurance bill, and the potential for outperformance in specific corridors if the tech and life sciences layer develops at the pace its current trajectory suggests. But you are accepting more volatility risk in exchange for that potential. Jacksonville gives you the lowest entry cost, the lowest insurance bill, the highest job growth rate, and the only price-to-income ratio in this analysis where the local market can sustain organic demand. The upside case in Jacksonville is materially larger than the upside case in the other two cities, and the downside case, given the lower purchase price and stronger employment fundamentals, is more limited. That combination of higher ceiling and lower floor is not something that shows up in every market. When it does, it deserves the attention that Jacksonville has not yet received. You watched this entire analysis for a reason. Not to collect information. You can find information anywhere. You watched it because you wanted someone to look at all of it together and tell you what it actually means. So here it is. No hedging. No. It depends on your personal situation. No responsible disclaimer that neutralizes the entire point. 3 cities, 3 profiles, 3 verdicts. The data already made the decision. What follows is just the honest reading of what it says. Tampa is the right answer for Stephanie, not because it is the most exciting market or because it offers the highest upside. It doesn't, and pretending otherwise would be a disservice to everything this analysis has built. Tampa is the right answer for Stephanie because her primary objective is not maximum return. It is stability, quality of life, good schools, a neighborhood that feels like a real place, and a financial structure that stops the bleeding from $4,400 a month in rent going nowhere. Tampa delivers all of that. The $395,000 median is real money, but it is real money that buys a functional city with a diversified economy, a cultural and lifestyle infrastructure that her kids will benefit from, and a housing market with an established floor that is not going to collapse under an economic shock the way a single sector market can. Her total monthly housing cost in Tampa, approximately $2,835, is still a significant reduction from her current Culver City rent, and it comes with equity accumulation, property tax deductions, and the psychological shift from building someone else's wealth to building her own. Tampa is the stable bet. For a buyer with Stephanie's profile and Stephanie's priorities, the stable bet is the right bet. Orlando is the right answer for a specific type of buyer that this analysis has tried to define carefully throughout. And it is emphatically not the right answer for everyone. If you are buying a primary residence in Orlando with a long time horizon and your financial plan requires that the city's economy remains broadly stable, you are accepting volatility risk that Tampa does not carry. That is a real trade-off, and it should be made consciously rather than by default. But if you are Kevin and your interest in Orlando is targeted, if you have done the zip code level work on the Lake Nona corridor, if you have run the numbers on the specific rental demand profile in the University of Central Florida Research Park area, if your model accounts for the tech and life sciences layer that is still in early development, then Orlando offers asymmetric upside in those specific corridors that the other 2 cities do not currently match. The verdict for Orlando is not yes or no. It is yes, but only if you know exactly what you are buying and why. A city-level bet on Orlando in 2026 is a mediocre bet. A zip code-level bet on the right Orlando corridor is a genuinely interesting one. Jacksonville is the answer that this analysis has been building toward since the first chapter. This is the market where the data aligns from multiple directions simultaneously. Entry price, insurance cost, job growth, net migration, price-to-income ratio, in a combination that the other 2 cities cannot currently match. $295,000 median, $2,800 annual insurance, plus 3.1% job growth, 28,000 net new residents in 2024, a price-to-income ratio of 2.95 that is the only one in this analysis where the local market can sustain demand organically without depending on in-migration from high-cost cities to prop up prices. For Kevin, Jacksonville is not just a place to live, it is a place where his $92,000 income puts him in a structurally advantaged position relative to the local market, where he can buy a primary residence and still have capital left to acquire an investment property, where the cash flow math on a rental works in a way it simply does not in Chicago or in the pricier Florida markets. Jacksonville is the Tampa of 2015, not in a speculative, hype-driven sense, in a fundamental sense. The numbers that preceded Tampa's repricing look like the numbers Jacksonville is showing right now. There is one more thing that belongs in this verdict, and it is the thing that the relocation content almost never says. The window on Jacksonville is not permanent. Markets get discovered the moment the national relocation narrative shifts from Tampa and Orlando toward Jacksonville, and the migration data suggests that shift is already beginning. The price-to-income ratio compresses, the insurance cost advantage gets absorbed into higher purchase prices, and the easy upside gets priced in. The people who are looking at Jacksonville right now running the numbers, and acting on what the data shows will look back on 2026 the way Tampa buyers look back on 2015. The people who wait for Jacksonville to become obvious will pay the price of that obviousness. That is how every market cycle works. In every city, without exception. The Florida that makes financial sense in 2026 is not the Florida that gets the most coverage. It is not Miami. It is not the version of this state that shows up on every best places list written by people who stopped updating their data 3 years ago. It is 3 cities with 3 different profiles, 3 different risk levels, and 3 different answers depending on what you are actually trying to accomplish. Tampa rewards the buyer who wants quality without gambling. Orlando rewards the investor who does the granular work. And Jacksonville rewards the person who is paying attention right now, before everyone else catches up. The data is in front of you. The question is whether you are going to use it.